price keeps rising back up in this long-term range where there's recently been a bearish star with a short lower wick. And with closing prices immediately going under its low, a sustainable downtrend is more easily established despite natural delays with price moving sideways or even slightly back upwards. Now a more complete long-term resistance range can be defined closer back up at this level near previous highs and spanning down to the low 34,000 range where the recent bearish star formed in line with many other previous downswing points. So as the chart returns back up to this region, it's quite normal to see a bearish star form despite the strong bullish momentum in the short term. However, it's green, so it's slightly less bearish. As usual, attention will focus on the bearish shooting star's lowest price. Although the next candle does close below it, it's just with average levels of volume. Together, the last three candles also form somewhat of an evening star candle pattern as well, due to the well-defined gaps between the candle bodies. Since the low of this pattern is not cleared, attention redirects back up towards the resistance range where there's another bearish star. Its proportions aren't ideal, but it still has the general structure we desire for a bearish reversal candle, where the upper wick is much longer than the lower wick, and there's a large drop from the open to close. And compared to the previous downswing point, there's much higher selling volume. There's a noticeably bigger drop this time. As we move along, the chart keeps returning back up to this range, but resistance holds strong, meaning it will be normal to see more bearish reversal candles, including the bearish shooting star pattern. But this time, the following candles don't even trade temporarily below this bearish shooting star's low, leading to another decrease in the chance of a downtrend forming, and instead leading to a breakout over this defined resistance range with adequate increases in buying volume. More bearish stars, but they are green and consistently close higher. So like some of the previous bearish shooting star patterns, this does not lead to a downtrend or even a minor downswing. Instead, we get a secondary outcome in that these candles mark a significant delay and eventually stall to the uptrend, which later leads to a more defined drop. As would be expected, the old resistance range reverses roles to provide support now. But not long after, these candles with longer upper wicks similar to the bearish shooting star form and steadily close lower under the previous bearish reversal range, which holds strong to repel a minor bullish retracement several weeks later. Now to another chart where the main focus will begin on a gap down, with particular emphasis on the 42 level that's in line with downswing points as well. Approaching 42, a bearish star forms, but only its high price is above the previous candle. It also forms with just average selling volume and is surrounded by green candles which have doji and spinning top features prior to a minor acceleration up to 42. These surrounding features result in a neutral to bullish stance. However, the bearish shooting star still highlights the beginning of a major slowdown to the established uptrend prior to the more solid move, with this bearish engulfing pattern decisively driving price back down away from 42. Later, when price returns back up towards 42, a harami and later bearish star highlight bearish sentiment extending well below the 42 level. In this case, the following candle briefly trades under the low of the bearish star, but manages to close back up, and the following candles proceed higher, but are unable to go past the bearish star's high. It's only when there's this larger red candle with increasing selling volume closing under the bearish star's low that provides the start of more decisive bearish confirmation towards a more significant downtrend. And from these more recent bearish reversal candle patterns, we can also mark 41.25 as an approximate level where more resistance has concentrated. Now on this chart, in the long and short-term context, this range has been quite influential. Now, even though price has briefly moved over 22, bearish sentiment is represented well with the bearish star and price immediately closing below it. However, 1970 now reverses roles to become a solid lower boundary, so it's not too surprising to see a return back to previous highs. It's a strong jump up, but the chart is unable to sustain closes above 2254 at the high of the bearish star, which helps extend and better define our range with more recent short-term context to highlight the increasing bearish advantage with the formation of this double top chart pattern. This next example is a good demonstration of a green bearish star that is ideally placed with its formation fully above the previous candle, followed by the next candle firmly closing below it, and preceded by more red candles, steadily taking price lower with increasing selling volume. All these features combined to contribute to a sharp drop that is sustained well into the future. Then when returning back up to the same range, there are obvious signs of resistance with these bearish stars recently taking place. But no drop happens since price doesn't close below their lows and instead closes above their highs. However, this does happen with the newest bearish star with a strong close under its low, in the process forming a bearish engulfing pattern as well. These candles can now be used as a reference for future resistance that does have some overlapping price ranges with the first major reversal point we looked at.